The headlines are screaming it. Investors are betting hard. Everyone thinks big rate cuts are coming. But what if they're wrong? What if the Federal Reserve has a completely different plan? And what if your money is caught in the crossfire? Today we're breaking down the truth behind the hype. Markets are predicting deep rate cuts. But the Fed isn't exactly on board. This is the clash between Wall Street's wishful thinking and the Fed's cold, hard math. And if you don't pay attention, you could get burned. So let's start with what the market is saying. Futures traders are pricing in cuts. Big ones. By the end of 2026, markets expect rates to fall below 3%. That's a massive drop from today. And investors are piling in. Mortgage refinancing is surging. People are rushing to lock in lower rates. It feels like a once-in-a-lifetime opportunity. Bond traders are celebrating too. They see falling rates as easy money. Buy now, profit later. But here's the problem. The Fed isn't promising any of this. In fact, they're warning the opposite. Chairman Jerome Powell and the Fed board keep repeating one message. They won't cut too fast, and they won't cut too far. Inflation is still sticky. The labor market is still strong. And the Fed is under political pressure not to look soft. That means they're cautious. Much more cautious than the markets. And that gap is where the danger lies. Think about it this way. If you're planning your finances around falling rates, you're gambling on the Fed. If they don't deliver, you're stuck. Your mortgage may not reset as low as you hoped. Your credit card rates may not ease. And if you've piled into risky stocks expecting cheap money, you could be sitting on a trap. Because if rates stay high, valuations can fall fast. This is why paying attention to the Fed's signals matters. Not just the market hype, because the Fed has the power, not Wall Street. Let's look at what the Fed is actually signaling. In their last meetings, they projected a slower path. Cuts, yes, but limited ones. They're targeting inflation control first. They're willing to keep rates higher for longer, even if markets hate it. And here's the kicker. If inflation ticks back up, they could even hike again. That's a nightmare scenario for investors betting on quick cuts. It's the kind of trap that wipes out gains overnight. And it's not impossible. So why does this matter to you? Because your money is tied to rates, whether you realize it or not. Mortgages, car loans, credit cards, investments. Every piece of your financial life is connected. And if you're counting on a big drop, you may be exposed. Here's how. First, housing. If you're waiting for lower mortgage rates to buy, you might wait too long. Rates could settle higher than you expect. Housing prices may not fall, and you could be priced out. Second, debt. Credit cards and personal loans track Fed policy. If rates stay high, so do your payments. People banking on relief could get crushed, especially if they're over-leveraged. This is how defaults pile up. Third, stocks. Investors have bid up tech and growth names because they expect cheap money soon. But if it doesn't come, valuations look stretched. Corrections get ugly fast. Now let's flip the coin. What if the markets are right? What if the Fed caves and cuts aggressively? That brings its own risks. Because rapid rate cuts usually mean one thing. The economy is in trouble. If growth collapses, if unemployment spikes, If inflation crashes into deflation, then sure, rates fall. But the economy is sick, and markets can still tank. So whether the cuts come or not, there's risk either way. That's why blind betting is dangerous. You need a plan. Here's how to think about it. Don't base your entire strategy on Fed promises, because they're not promises. Build resilience. If rates stay high, how do you survive? If rates fall, how do you benefit without overexposing? For individuals, that means simple moves. Lock in affordable refinancing if it makes sense now. Don't gamble on waiting forever. Pay down high-interest debt today, because betting on rate relief could backfire. And diversify your portfolio. For investors, it's about positioning. Balance growth with safety. Don't assume the easy money flood is coming back. Look at sectors that can handle higher rates. Energy, commodities, defensive plays. And hold some cash to strike when others panic. Because when the market realizes the Fed isn't cutting as fast as expected, volatility will spike. And that's where opportunity lives. Remember this: the Fed's job is not to make you money. It's to control inflation and stabilize the economy. And they'll sacrifice your portfolio if that's what it takes. So where do we stand? Markets want a storybook ending. Rate cuts that save everyone. But the Fed is the one writing the script. And they don't care about market fantasies. They care about their mandate. If you follow the hype, you'll get burned. If you follow the data, you'll see the risks. And if you prepare both ways, you'll win. Because in the end, interest rates are not about hope. They're about power. And the Fed holds it, not the markets. Final takeaway: don't gamble on rate cuts. Plan for what's in your control. And when the crowd is wrong, that's where real wealth is built.